guys, it's your boy Toby. Welcome to our course on forex trading. But then, first of all, we're going to be treating what is forex. Now, somebody's going to be asking forex, what's forex or what's forex all about? Now, here we're presenting a comprehensive forex trading tutorial, Introduction to Forex Trading Complete course. Now, what is forex? Forex simply means exchanging one currency with another. As you could see over here, exchanging dollars for euros. Now, Forex stands for foreign exchange, which is exchanging one currency for another. You sell a currency and buy another currency. And once you do so, you've essentially involved yourself in the Forex market. In Forex trading terms, assuming that you're an American and you visit South Africa, which means you've sold dollar and then bought rands. If you're an American, you visit UK, you've sold dollar and then you bought pounds. Okay, the foreign exchange market known as FX is the largest financial market in the world. The foreign exchange market looks absolutely beautiful with its $4 trillion a day trade volume. Now, this is $4 trillion a day trade volume. This is the amount of money that goes into the foreign exchange markets on daily basis on the internet. Now, because you're not buying anything physical, sometimes this kind of trading could be very confusing. Now, think of buying a currency as buying a share in a particular country, like buying a stock of a company. Now, the price of the currency is a direct reflection of what the market that thinks about the current and future health of that country that you're going. And then, for instance, when buying the Great Britain pounds, you are basically buying a share in the British economy and you are betting that the economy is going to do well, isn't it? Okay. And will even get better as time goes through analyzing using basic methods. Now, since or once you sell those shares back to the market, hopefully you will end up with a profit. In general, the exchange rate of a currency versus another is a reflection of the condition of that country's economy compared to another country's economy. And then we're going to be treating major currencies traded. What are those major currencies traded? Now, if you look over here, you'll see United States dollar, you see euro, you see Japanese yen, you see Great Britain pounds, you see Switzerland francs. Here you see Canadian dollar. Here you see Australian dollar. You see New Zealand dollars. And then to all these currencies mentioned over here, we also have their nicknames, okay? And then the nickname for US dollar is actually called buck. Then the nickname for euro is fiber. The nickname for yen is same as yen. The nickname for pound is cable. The nickname for France is Swizzy. The nickname for Canadian dollar is Loonie. The nickname for Australian dollar is Aussie. Then the nickname for New Zealand dollar is Kiwi. Just like you know the Kiwi Polish. He said the symbols always have to them. Now these are supposed to have symbols, okay? But then the symbols has always always had to them three letters. The symbols have to them three letters, which signifies the first two letters specifies the name of the country, to which the third letter specifies the name of the country's currency. Now take USD for instance. The US represents United States and the D stands for dollar. Easy enough, right? Now the currencies includes in the charts or the currencies included in this trading platform, as you will see, are actually called the majors. They are determined as the major currency pairs that are traded in the world's global financial markets. And then we're also going to be talking about leverage. Now, what is leverage? Leverage is borrowing money from the forex brokers so that you can get an even bigger exposure to the market. Now, you don't pay any interest in this loan or in the loan. So in forex trading, a small amount of deposit can control a much larger or large contract value. Okay, now leverage gives a trader the ability to make nice profit. It gives a trader the ability to make better profit and to keep risk capital to a minimum. Now with $100 you can handle a currency that's worth 1,000 US dollars. Now, e.g., let's say example, if you make 2% of that $1,000, that means you have made 20 dollars, and your trading account will become 120 US dollars. And we're also going to be talking about now, looking at the diagram here, you could see the effect of leverage. Now you have, let's say for instance, $100 here. You will be able um, to have the opportunity of trading with as much as this money, as I said, up to 1,000 US dollars. And then here it shows the same diagram here. You deposit $100, as little as $100, you're able to get up to 1,000 US dollars to make a better trading decisions and to make a better profit with your trading. And also we're going to be talking about leverage sizes. What are those leverage sizes? Now we have 1 is to 50, 1 is to 100, 1 is to 200, 1 is to 500, 1 is to 1,000. Now, for example, a forex broker may offer 1 to 50 leverage, which means that a $50 margin would enable a trader to buy or sell 2,500 worth of currencies. Similarly, with $500, one could trade with the amount 25,000 US dollars and so on. While this is all gravy, now let's remember that leverage is a double-edged sword. Without proper risk management, this kind of high degree of leverage could lead to large losses as well as gain. So it depends on how you manage your risk, how you set and or how you make your risk, how you take your risk management. And then when that is done, you will always end up making some attracting and appreciating profits. Okay, as a forex trader, all we have to also understand is that making good trading decisions matters a lot as a forex trader that is growing to build a career in this firm. And then you are probably wondering how a small investor like you and I could trade that large amount of money. Now think of a broker as, or think of your broker as a bank that basically borrows you 100,000 US dollars to buy currencies. All the banks ask is that you set aside the 1,000 US dollars as a good faith deposit, which they will hold for you but not necessarily keep. Now sounds too good to believe, right? Now this is how trading forex using leverage works. So most of the times you could actually negotiate with these brokers, and you may just want to tell them, okay, I have $1,000, how much are you guys going to give me? And then you select the leverage. If the leverage selected is allowed, automatically it will show in your trading account. But if not, they will not accept it, and that means that you have to select a lesser amount before you then get what you actually need to make this trading work for you. So the amount of leverage you use will depend on your broker and what you feel comfortable with. Typically, the broker will require a trade deposit, also known as account margin or initial margin. Once you have deposited your money, you will then be able to trade. Without money in your account, there is no way you can access this account, okay? So the broker will also specify how much they require per position lot traded. Now, for example, if you uh, if the allowed leverage is 1 is to 100 or 1% of position required, and you wanted to trade a position of 100,000 US dollars, but you only have $5,000 in your trading account, no problem, as your broker will set aside a 1,000 US dollars as down payment or margin, and then lets you borrow the rest, of course. And then any losses or gain will be deducted or added to your remaining cash balance in your own account. Now, the minimum security margin for each lot will vary from broker to broker. In the example above, the broker requires a 1% margin. This means that for every $100,000 traded, the broker wants 1,000 as a deposit on the position. Also, so we're going to be discussing a 24-hour market. What is a 24-hour market? Now, the Forex market is a seamless 24-hour market. Most brokers are open from Sunday at 11 p.m. GMT until Friday at 11 p.m. GMT, with a customer service usually available 24/7, with the ability to trade during the US, Asian, and European markets hours. You can customize your own trading as well. So looking here, you see London, Tokyo, Sydney, New York, and Europe. So these are actually plugged into the Forex market sections, and these times also are plugged into same trading system. And then we'll be talking again. The next subject is execution of market orders. What is an execution of market order? Traders are instantly actualized under usual market conditions. Under these conditions, usually the price shown when you execute your market order is the price you get. You are able to execute direct off real-time streaming prices. Many brokers only guarantee stop, limit, and entry orders under normal market conditions. Trading during a massive alliance inversion from outer space would not fall under normal market conditions. Now, fees are instantaneous most of the time, but under extraordinary volatile market conditions, like during Martin attack, other executions may experience delay. So why am I showing you this diagram? Now, talking about market executions, here you see over here at the top here, you see market execution, and then here I think we should be we should see something market execution, instant execution here. Now, this diagram here shows you how the system looks in your computer or in the system you're using. Either is a desktop you're using or computer or laptop, let's say. And then this shows you how it looks in your phone, in your Android phone. So if you want to execute a trade, market execution, as they have said, what you need to do, if you want to buy, you just hit here and then you're able to buy. If you want to sell, you just hit here and then you're able to sell. If you want to sell, you hit here in your system using your cursor to enter the trade, and then the market will be instantly executed. And then also, if you want to sell, if you want to buy here, you just hit here and then the market will be automatically executed. And then apart from that, we also have another topic that is called market structure. What is a market structure, guys? For the sake of comparison, let's first examine a market that you are probably familiar with, the stock market. These are the stock market. Over here you see what's going on here. See a lot of the market owners. These are market masters. We have a NAFDAC company here. So these are what I call market structures. These are all market structures. All these things you see here, market structures. As it said, this is how the structure of a stock market looks like. Now, by its very nature, the stock market tends to be very monopolistic. There is only one entity and one specialist that controls prices. Now, all trades must go through this specialist. Because of this, prices can easily be altered to benefit the specialist and not the trader. Now, how does this happen? In the stock market, the specialist is forced to fulfill the order of its client. Now, let's say the number of sellers suddenly exceed the number of buyers. The specialist, which is forced to fulfill the order of its client, the sellers in this case, is left with a bunch of stock that he cannot sell off the buyer's side. And then we also have some other subjects that will be treating this. Talked about how to read Forex quotes, how to read Forex quotes. If you see here, you could see now currencies are quoted in pairs. As you see here, Euro USD currencies are quoted in pairs such as Euro USD, USD JPY. Now the reason they are quoted in pairs is because in every foreign exchange transaction, you are simultaneously buying one currency and selling another. Now, here is an example of a foreign currency exchange rate for British pounds. Foreign currency exchange rate for British pound. Now, the British pound here, as you could see over here, this is the British pound. What the British pound gives. Okay, so so this is the British pound. This is the price for British pound. Thing, yeah. So these are the prices, and each of these prices are determined to be bid, and then each is determined to be asked. So as you could see, you are simultaneously anytime this happens now, in the foreign exchange market, whenever you see currency pairs quoted in this form, there are um, there are strategic there are most often pairs are interpreted in this form. It could be that it's not actually what you see here, Euro USD, but then it could be any of these pairs. But I bet you it's definitely what it means. That's what it means. Now, here is an example of a foreign exchange rate for British pound, as you could see over here. And then the first listed currency to the left over here, they said the over here of this to the left of the slash is determined to be the base currency. It's known as the base currency. And then in this example, the British pound or the euro here, in this example, the euro here is the base currency. And then also we have some other ones that when buying the exchange rate tells you how much you have to pay in a unit of quotes currency to buy 1 unit of the base currency. And in the example above, you have to pay 1 point. Now, in the example above, you have to pay 1.12042. You have to pay this amount of money to get 1 British pound. You have to pay this amount of money to get 1 British pound. So let's take for instance, this is dollar and then this is euro. Let's just take for instance. So this is how um, uh, reading forest market quote works. Now, when selling, the exchange rate also tells you how many units of the quote currency you get for selling 1 unit of the base currency. Now, in the example above, you will receive just like the same way I explained the first with the first diagram. That's how it works. Now, the base currencies is the basis for the buy and then or the sell. Now, if you buy Euro USD, this simply means that you are buying the base currency and simultaneously selling the quote currency. In a simple term, buy Euro and sell USD. Buy Euro and sell USD. Now, you would buy the pair if you believe that the base currency will appreciate, gain value relative to the quote currency. You would sell the pair if you think the base currency will depreciate, lose value relative to the quote currency. Alright guys, so we just forge ahead again, and then we'll also be looking at a short and long or long short. What does it mean to say long short in forex trading? First, you should determine whether you want to buy or sell. If you want to buy, which actually means buy the base currency and sell the quote currency, You want the base currency to rise in value, and then you would sell it back at a higher price. In traded stock, this is called going long or taking a long position. Just remember long. Long means buy. That is what you see here. So long here, as you see this long, it says long means buy. If you want to sell, which actually means sell the base currency and then buy the quotes currency. You want the base currency to sorry, you want base currency to fall in value, and then you would buy it back at a lower price. This is called going short or taking a short position. Just remember short. Short means sell. So all forex quotes are quoted with two prices. Forex quotes are quoted with two prices. If you open your chart right there, you would discover, if you open your MetaTrader 4 chart, you will discover that there is these two horizontal lines that moves with the candlesticks. There are just two horizontal lines that moves with the candlesticks. Those lines are actually determined to be called the price. And now the price or the bid is lower than the price. The price is at the top, and then the bid is the next. The bid is the price at which your broker is willing to buy the base currency in exchange for the quotes currency. This means the bid is the best available price at which you, the trader, will sell to the market. Now the ask price is the price. The ask price is the price at which your broker will sell the base currency in exchange for the quotes currency. This means the ask price is the best available price at which you would buy from the market. Another word for ask price is offer price. Now the difference between the bid and the ask price is popularly known as spread. So it's popularly known as spread. Now, how do you identify spread? Now, looking at this, the price there in your MetaTrader 4, as you download it, looking at the price over there, one thing you will notice very well is this. Now, all you do for me is that you please look very well. You see that in between those two prices, the bid and the ask, there is a space in between them. That is what is determined to be known as spread. Now on the Euro USD quote above that you saw, on the Euro USD quote, now the bid price is, let's take for instance the bid price is so so and so. Let's take for instance the bid price is let's say 1.12042. Okay, or let's say the bid price is 1.34588. Now the broker makes it so easy for you to trade away your money. Why? Because of the spread. Now if you want to sell the euro, you click sell. If you want to buy euro, you click buy. As simple as it appears, and you will buy euro at a certain price. Wherever you see the price at that point, please, that is where your price should be. That is where the price will be taken from. Immediately you execute a trade, the price, wherever you see those prices, the bid and the ask price, wherever you see them, that is where the price or the market will be instantly executed. And we're also going to be talking about what is pips and pipet. What is pip and pipet? Now in this section, a little math is required to calculate your profit or loss. You've probably heard of the term pips and pipets, lot and lots more. And here we're going to explain what they are and show you how they are calculated. Now you take your time with this information as it requires knowledge for all forex traders. Don't even think of attempting about trading until you are comfortable with your PIP values and calculating profit and loss. Now in this case, you don't do the calculation. You don't even think of engaging into this market if you are not comfortable with the calculation of your pip and pipet. Now let's take, for instance, here we have 1.13215, and then after some few minutes or after 1 hour you find out that this thing has turned to 1.13216. How many pip did the market move? The market moved just 1 pip. That is what it means. And then we also talk about pipet. Pipet actually explains this. Pipet explains this. How does it explain it? Now, the unit of measurement, we're going to now, what the heck is pip and what about pipet? Now, this gives a clear understanding or a clear explanation of what it's all about. Now, looking at the two also, it say the unit of measurements to express the change in value between two currencies actually called pip. Now, if Euro USD moves from, as you say, it 1.13215 to 1.13216, it's moved 1 pip. That is exactly equal to 1 pip. Now, a pip is the last decimal place of a quotation. Now, given that 4 decimal places are used for pairs without the Japanese yen, so these are actually used for pairs without Japanese yen. Now, these are the 4 decimal places, 1, 2, 3, 4. Now, when quoting or when calculating your profits or your pips, this is how you do it. Now, you say 1.1321 and not adding this, because whenever you add this, in other words, you've actually added the 5 decimal point or the 5 decimal place. That actually means that you are now calculating it in pipet value and not in pip values. So whenever you're calculating your pips, what you do is that you calculate from here 1.1321 and then you end it. So if the market moves from 1.1321 to 1.1322, it moved 1 pip. That is what it means. Same thing is applied here. Now this is determined to be pipet because in this particular pair, this pair have a Japanese yen. Now I'll read I will explain this again. A pip is the last decimal place of a quotation, given that 4 decimal places are used for pairs without Japanese yen. So these 4 decimal places from here are used for pairs without Japanese yen. But any pair that have the Japanese yen on it, you could actually calculate from here to this last number in order for you to get the accurate figure of what you wanted. All right, so this also is very important. Now, there are brokers that quote currency pairs beyond the normal standard 4 and 2 decimal places to 5 and 3 decimal places. Now, these are 3 decimal places and these are 5 decimal places. There are brokers that quote off real time, like they said they are quoting fractional pips. All those are determined to be fractional pips, also called pippets. Now, for instance, if Euro USD moves from let's say 1.51542 to 1.51543, it's moved just 1 pipet if you are to be calculating here, or if you are to be calculating and adding this 5 decimal place or 5 decimal points. And also we're also going to be talking about the next on the board. We're going to be talking about types of orders. Now, the term order refers to how you will enter and exit a trade. Here we discuss the different types of orders that can be placed into the foreign exchange market. Now, be sure that be sure that you know or you fully understand which type of order your broker accepts. Different brokers actually accept different types of orders. Now there are some basic order types that all brokers provide, and some orders that sounds weird. Now we have some other ones like what you see on the background here, and then sorry, we have so often we have buy stop order, we have sell stop orders, we have buy limit order, we have sell limit orders. So most of these orders say orders placed above prices. Buy stop orders are order placed above prices, and price keeps going up. Now if you look here, anyway, I was going to explain that in a plain chart using the Metal Trader 4 platform to explain this in our next tutorial. But in order to get to understand this very well, please, you might just want to subscribe to our channels, so as to get the full details of what we training you on how to we training you on how to get a better knowledge and how to make a good trading decision in this forest industry, in this forest trading industry. And also we're also going to be talking about market orders. Now what is market order? A market order is an order to buy or sell at the best available price, as simple as that. Now for example, the bid price for euro USD is currently at, let's take for instance, currently at 1.2140, and the ask price is at 1.2142. If you wanted to buy euro at market or at the market, then it would be sold to you at the ask price of 1.2142. Now you would click buy, and your trading platform would instantly execute a buy order at that exact price. So that is what it means. Just click a buy here. If you want to buy, it's a trade. So you click a buy or you click a sell, and then the trade will be instantly executed. And also we also have a limit entry orders, which are stop entry orders, we have stop loss on orders, we have take profit orders, and so and other more. Now limit entry orders, I've told you. And limit entry orders, let me just explain, make a little explanation so now it works. Limit entry orders is an order placed to either buy below the market or sell market above the market at a certain price. Now for instance, let's take euro USD is currently trading at 1.2050, and you want to go short if the price reaches 1.2070. You can either sit in front of your computer or monitor and wait for the next day, at which you would click a sell or a sell market order to set this trade ahead of time. And then when that is done, there is the market will instantly be executed. Immediately the price comes to hit the market or the limit entry order you have placed. Now let's say or you can sit or you can set a sell limit order at so and so price at where you want it, and then you would walk away from your computer to do whatever else you have as your daily scale or your daily routine. Now if the price goes from so and so price to so and so price, your trading platform will automatically execute a sell order depending on the level where this trade is being executed at the best available price. Now you use this type of entry orders when you believe prices will reverse upon hitting the price you specified. So this is how it works. Apart from this, guys, there is nothing else. We also have stop loss. I think yes, that's stop entry orders. We have stop loss end orders. Now stop loss orders are is a type of order linked to what? A stop loss order is a type of order linked to a trade for the purpose of preventing additional losses if price goes against you. Now remember this type of order. A stop loss order remains in on effect or in effect until the position is liquidated or you cancel the stop loss order. For example, if you want to go long the Euro USD at so and so price, to tells you or explains where you're supposed to actually set this sell limit order or buy stop order or stop loss order. Now, talking about stop loss orders, now how do I set the stop loss order? The easiest way to do this is this. Now, when you're selling from the or from the resistance, your stop loss order should be above the resistance. Your stop loss order should be above the resistance. Now you are selling below the resistance levels or the resistance zone. So your stop loss should be above the resistance. And then if you are buying a trade, now what happens is that your stop loss should be below the support levels, below the support level. If you are selling, your stop loss should be above the resistance levels. But if you are buying, your stop loss should be below the support levels. And then this is how you get most of these things done, guys. Now your trade will remain open as long as the stop loss has not gone to hit. It will either remain open in profit or better still. Okay, so also we have some other market analysis, say 3 types of market analysis online that every trader specializes, or most often some of the traders actually doesn't engage with this type of analysis. But why am I bringing this analysis to you is because this analysis actually gives you a balanced knowledge of what you're coming to do. Just think of trading with just your technical analysis knowledge, and then whatever happening with the fundamental analysis you don't know, whatever happening with the sentiment analysis you don't know, then we've gone past all that stage. So what we're doing is this. We're actually going to be showing you now to make a proper analysis on that of the technical analysis and the fundamental and then sentiment. But that's going to be on our next tutorial. But in order to get notified when these videos are uploaded, guys, please hit on that subscribe button and of the bell icon. If there be any mistake you identified on the course of this training, please just comment below and let us know, just to make a better just to make a better videos and to make better projections of the courses that will be projecting to you guys. But we're also going to be touching this technical analysis a bit. And now, what is technical analysis? Okay, let's take for instance, and to begin, let's look at 3 ways on how you would analyze and develop ideas to trade the market. Now, there are 3 basic types of market analysis, which is 1, technical analysis here, and then 2, fundamental analysis and sentiment analysis. Now, technical analysis is the framework. Technical analysis, I'm talking on technical analysis now. It says the framework in which traders study price movement. The theory is that a person can look at historical price movement and determine the current trading conditions and potential price movement. Okay, so the main evidence for using technical analysis is that theoretically all current market information is reflected in price. So if price reflects all the market information or all the information that is out there, then price actions is all one would really need to make a trade. Now, have you ever heard the old adage, history tends to repeat itself? History tends to repeat itself. This is basically technical analysis. Now, well, That's basically what technical analysis is all about. If a price level held as a key support or resistance in the past, now traders will keep an eye out for it, and based on their trading experience or on their trades around the historical price levels, typically or technical analyst looks for similar patterns like what happened previously, what happened before that particular what happened before that particular analysis, because for that particular moment you're doing your analysis. And now typically or technical analysts look for similar patterns that have formed in the past and will from it generate ideas, believing that price will act the same way it did the other day. Now, price actually have problems breaking what there's resistance and the support, and this is how you trade with using technical analysis. Technical analysis have this nature of it has everything to do with scaling up your support and resistance levels, scaling up trend lines, and some other Fibonacci retracements and all. And then in the world of trading, when someone says technical analysis, the first thing that comes to mind is a chart. Technical analysts uses charts because they are the easiest way to visualize historical data. These are the easiest way to actually analyze what's going on in the market. Now you can look at the past data to help you spot trend and patterns, which could help you find some great trading opportunities as a trader. Now what's more is that with all the traders who really on technical analysis out there, these price patterns and indicators signals tends to become self-fulfilling. As more and more traders look for certain price levels and chart patterns that are more likely that these patterns will manifest themselves in the market. Now you would know though that technical analysis is very subjective, just because Timber and Sabisusu are looking at the exact same chart setup or indicators doesn't mean that they will come up with the idea of where price will be headed to. The importance of this thing or the importance of technical analysis is that you understand the concept under technical analysis, that you won't get a headache whenever somebody start talking about Fibonacci, Bollinger Band, pivot points, and for other more. And we also have fundamental analysis. Fundamental analysis is a way of looking at the market by analyzing economic, social, and political forces that affect the supply and demand of an asset. If you think about it, this makes a whole lot of sense. Just like in your economy, it is demand and supply that determines price. Using supply and demand is an indicator, or there is an indicator of where price could be headed easily. Now the hard part of analyzing all the factors that affect supply and demand, in other words, you have to look at different factors to determine whose economy performs well and whose economy is not. You have to understand the reason of why and how certain events like an increase in an unemployment affects a country's economy and ultimately the level of demand for its currency. The idea behind this type of analysis is that if a country's current or future economic outlook is good, their currency should strengthen. The better shape a country's economy is, the more foreign businesses and investors will invest in that country. This results in the need of purchase country's currencies country's currencies to obtain those assets. And also we're going to be talking about sentiment analysis. What is sentiment analysis? Now, earlier we said that price should theoretically actually reflect all available market informations. Unfortunately for us traders, it isn't that simple. The market do not simply reflect all the informations out there because traders will just act the same way. Of course, that isn't how things works. Each trader has its own opinion and explanations of why the market is acting the way that it does. Each trader's thoughts and opinions, which are expressed through whatever position they take, helps form the overall sentiment of the market. The problem of that as traders, no matter how strongly you feel about a certain trade, you can't move the market in your favor. Even if you truly believe that the dollar is going to go up, but everyone else is bearish on it, there is nothing much you can do about it. Now, as a trader, you have to take all this into consideration. It helps to you to gauge how the market is feeling. However, it is bullish or bearish. Ultimately, it is also up to you to find out how you want to incorporate market sentiment into your trading strategy. If you choose to simply ignore market sentiment, that's your choice. But they were, but there you are telling you now, it's your loss. So doing with sentiment, fundamental and technical analysis gives a trader what is called a balanced knowledge. It gives you a balanced knowledge. That's what makes you really powerful, and not all other um or not all other um blah 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 that normally comes out from these new beginner traders and all that. Now, in conclusion, the basic order types, market limit entry orders, stop losses, trailing stops are usually all that traders ever need. Unless you are a veteran trader, don't don't worry, with practice and time you will be. Now, don't get fancy and design a system of trading requiring a large number of orders sandwiched in the market at all times. Stick with one basic stuff first. Make sure you fully understand and are comfortable with your broker's order entry system before executing a trade. Also, always check with your broker for specific order information to see if any rollover fees will be applied if a position is held longer than 1 day. Keeping your ordering rules simple is the best strategy. Now, do not trade with real accounts until you have an extremely high comfort level with the trading platform you are using and its other systems. Erroneous traders are more common than you think. So please, guys, do not think of attempting to do anything else until you are comfortable with what you have learned, until you are comfortable with making profit, probably putting the stop losses and take profits and more. But until then, I want you guys to please stay connected again. If you've not subscribed to our channel, please do well and subscribe to our channels, and so as to get we're going to actually be releasing some strategy that makes you very profitable in this forex trading market. You might just want to check on our trading platform on our YouTube channels. check on the previous trades we've made, we've actually been posting most of the live trades we make on daily basis. And that's what makes us what we are today, and that's what gives us the knowledge we are distributing to the world. All right, guys, my name is Toby again. I want to say thank you for listening. Please stay connected as we move the world's market to the next level. Alright guys, it's your boy Toby. In this video I'm going to show you the 365 accurate trade setups that happens in 365 days in a year. But in order to get all the trade setups and patterns, please hit on the subscribe button right there and turn on the notification button so as to get notified whenever we post a new video. So in this case we're going to be discussing these actually are intermediate and advanced trading course. Okay, so in this case we're going to be discussing the accurate trade entry setups, all accurate trade entry setups, and then the topic over here is an introduction to the world of trendline trading strategy. So we're going to take you through all the trading strategies, all the trade setups and patterns that happens in 365 days that we have, as in to say a leap year. So forex trading, or trading in forex market, is a challenging opportunity where above average returns are available to educate and experienced investors who are willing to take above average risk. However, before deciding to participate in forex trading, you should carefully consider your investment objectives, level of experience, and risk appetite. Most importantly, do not invest money you cannot afford to lose. Now, there is considerable exposure to risk in any foreign exchange transaction. Now, any transaction involving currency involves risk, including but not limited to the potential for changing political or economic conditions that may substantially affect the price or liquidity of the currency. Now, moreover, the leveraged nature of forex trading means that any market movement will have an equally proportional effect on your deposited fund. Now, this may work against you as well as for you. The possibility exists that you could sustain a total loss of initial margin fund and be required to deposit additional funds to maintain your position. If you fail to meet any margin call within the time described or prescribed, your position will be liquidated without prior notice to you. Now, you will be responsible for any resulting losses. Investors may lower their exposure to risk by employing proper risk management. So in this system, we're also going to be looking at the overview of trendline trading strategies, and then but before we take you there, please stay connected. If you haven't if you've not met me before, my name is Toby, but just in case you've not subscribed to our YouTube channel, please do to help promote our videos. In this what we do, we actually upload our videos every Friday, every Saturday by Friday 6 p.m. Sometimes on Saturdays 10 a.m. in the morning. So in order to stay connected, guys, please hit on the subscribe button right there and turn on the notification button so when a new video is being uploaded online you get notified. All right, please, you might just want to also like, comment, or share the videos to help other traders out there get an even bigger or better exposure to this world of trading. Now, on this chart here, you could see that only 3 trades and 800 floating profits is secured, and majority of the profit logs, and then the trader is not up yet, and all this is just in 1 week. Now this pair was still the trade was still heading downward when the screenshot was taken. Now these are one of the major trade setups that happens in our daily trades. Now I've come to notice that in everyday trading there is a pattern that forms. There is a pattern that forms. There is some few trade setups that forms, but just one of it is very accurate. Now we're going to also be showing you some of the fundamentals. We're going to be making this very understanding to you, and then we're going to be displaying the setups that you will see, all the setups and their accurate entry point. Now over here you could see that the first trade got 421 pips floating profit, and then the second one got 315 pips floating. Then the third trade here got 64 pips floating profit. And then we're just going to show you as much as we can. But then over here too, we have this pinpoint deadly accuracy. The trend line entry was taken in 15 minutes time frame, as you could see over here. It was taken from 15 minutes time frame, and then after some few hours, and then after 7 hours, this is how the trade turned to become. Now the previous trade, as you could see over here, the previous setup was identified here. At this particular spot, a sell signal appeared over here that made it very clear. Now a sell signal didn't just appear, it appeared at a certain level, at the touch of the trend lines. So we're just going to be considering some few things. Now when the trade moved the first time, the profit here was $113, and then after some few hours, after 7 hours thereabout, this is what the profit turns to become. And then the profit turns to become the first trade, which is this, turned to become 780. Now it's now left with $718 over here. And then the second trade, which is taken from here, is now 168 US dollars. Now this is the power of the trend line trading strategy, and it's dead simple to use. And this system, it allows you to enter high probability trades with pinpoint accuracy and captures maximum profit effortlessly. It's price driven entry based on what happens on touch of the trend lines. So we actually take our trades, we decide what's going to happen at a particular point. That's how we decide our trade. Now if there is a trend line setups, in this case we're only waiting for a touch. Now what is that touch? We're also going to be showing you at the accurate point where you're supposed to enter. Now we're not just waiting for a touch, but there are accurate entry spots. So this is a trend line following strategies that will allow you to make trades with trend, which means you have the old stacks on your side. So this allows you to make a good trading decisions. And then we're also going to be looking at the overview of trendline trading strategies. Now what are the overviews? The time frames, you can use any time frame, and then you can use any pair. You can indicators, no, indicators are not needed at all. So in this case, this is a general setup for long entry or buy setup. So when you say long entry, it actually means a buy or a sell setup. So in this video we just I think with a buy setup. Yes, so the entry you could see over here, it said one. This is trend line, as you could see drawing here. This is a trend line with a red line, and then it says first and second. Now general trade setup. Now points 1 and 2 are used to draw a trend line. Please stay tuned now. Pay attention to this this area. Say point 1 and 2 are used to draw a trend line, and then wait for point 3 and 4. Now this is point 3, and then wait for point 3 and 4 and etc. to happen for a entry. So the point 3 here is used for our entry, and then points A and B are used to take profits. Here A and B are used to take profit. Now this is how you make accurate trades. Then we're also going to be showing you the opposite, which is the next which is the descending trend line. And then in this case, it said general setup again. It said point 1 and 2 are used to draw trend line as it explained, and then point 3 and 4 is used for entry, and then points A and B are used to take profits or exiting the trade. Now would you like to or you could have taken this trade shown below with almost pinpoint deadly accuracies with the trend line strategies if you were smart then. But then I want you to notice what happened with this when the market came to this level and then broke down a little bit, came over here again, came down to come and creates another level here. Now this is determined to be now it said first and second points or pinpoints are used to draw trend lines. So you make your drawing from this level here and then with this, and then when the three when the chart comes to touch the trend line the third time, the third touch is used for entry, and then the fourth touch is used for entry, the fifth, the sixth, the seventh, the eighth, all these are used for entry. Now this is the reason why. Now how many times did price test on this level? Now looking at it, how many times price test has tested? Multiple times. As a matter of fact, this more than 4 times. I was looking 1 2 3 4 5 here, as you could see, and then the trader here made a lot of profits, a lot of profit. Now trendline trading strategy also allows you to get in at most the beginning of a new trend or starting of a market swings or setups or bottoms or to whichever you want to make it. It allows you to get accurate entry points, or if you miss the beginning and you hope to maybe join the market sometime in future, maybe when a trade setup, if you miss the first setup here or the second setup, you might just want to join here, since you maybe after some time you draw a trend line, then you discover that the market is moving upward. All you need to do is just look for an opportunity again to enter another trade setup to get an even bigger exposure to the market with your leverage. Okay, so in this case we're also going to be now this is where the leverage helps us to make better profits. Now when, let's take for instance, you have some good amount of money in your account and then you got these opportunities. Now there's one thing that we have to understand. Now I've met some student that called me sometime, and they go like, we have better opportunities, but then we don't have enough money to make better profits in this market. And just okay, you might just want to increase your leverage, or better still, just look for some $100 extra, $100, and then add it into your trading capital, add it to your trading margin, so as to get an even bigger exposure to the market. Now trading trend line strategies like this requires good amount of money. When you do that, you get good profits from these trading setups. And then we're also going to be, now you notice how the market over here, reacted with the price, and then the price obeyed this trend line below and then make a downward movement. You notice over here again, it said first and second is used for a trade setup, and then the third one you might just want to buy, then the fourth buy, and you might just want to sell, then the fourth you sell, depending on what you see with your trades. Okay, just keep it simple. This trend line trading strategy is one thing that has made a lot of young youths out there millions. Okay, so in this case we're also going to be discussing now, trendline trading strategy helps you to build a good trading to build a good trading experience in this system. Now, before I get you into the rules of the trendline trading strategy, you need to build a good foundation of understanding how this trading strategy works. Now, this includes how to draw a trend line. Now, how do you draw a trend line? We're also going to be discussing these outlines, how to draw a trend line, when is a trend line still valid, and when does it becomes invalid. Understanding some common mistakes in drawing trend lines, how to know when a trend line are most likely to hold and when and which one will not. Now, support and resistance and how to use them to your advantage. Also going to be talking on understanding trends and know when they may be starting or ending. Now, technical analysis, the best way to analyze your charts without too many indicators. Matter of fact, you do not need no indicator to be engaged into this market. Now, having good understanding of a point listed above or this point listed above is very essential for the successful application of the trendline trading strategies. So these are just how this system works. This is how the system works. Trendline trading strategies has helped a lot of young youths out there. I've met a lot of young youth that what they are suffering today is as a result of not having the trendline trading strategy knowledge. So they just, so most of them wants to use the indicators for which they don't actually know the how the most of these indicators works and how they react most of the times when there are trade setups and patterns. And then also we're so going to be showing you now how to draw a valid trend line. He said first, which is step one, is to identify obvious peaks. So identify obvious peaks and truths. And then step 2A is say connect a minimum of 1 and 2 peaks, 1 or 2 peaks. Yeah, I think connect a minimum of 2 peaks or highs with a line from left to right, and you have a trend, a downward trend line. Connect from your left to your right, and then you have a downward trend line. And then step 2B, connect a minimum of 2 truths or lows with a line, and you have an upward trend line. Please subscribe to our channel if this is your first time or being with us here in this channel. My name is Toby. Please subscribe to our channel to help us promote our videos. Alright guys, this is your boy Toby. Welcome to season 2 of introduction to trendline, to the world of trendline trading strategy. So in this case we're going to be to continue from where we ended last time, how to draw a valid trend line, which we discussed most of these outlines, but then we just go into straight into looking at the charts so as to also know how to identify a moving or how to draw an exact trend line. All right, so we just switch over to our next assignment on this. Okay, so this is it, how to draw trend lines. It's identify obvious peaks and truths. So in this case, here is a peak and then here is a peak. It's identify obvious peaks and truths. Here is a peak and then here is a peak, and then peak here and then another peak here, and then this is a true and then this is a true obvious peaks. So in this case, we just in case they ask you, okay, so put a trend line on this pinpoint or on these peaks. How would you draw it? Are you just going to draw from this to this? Are you just going to connect the trend line from here to here, or from here, or from here to here, or you're connecting from here to here downward, or you're connecting from here to here? How would you do that? All right, so let's look at our next chart and see how it's drawn. So here, this first and second peak is it. We use the first and second peak to draw the trend lines. So over here, there is a first and second peak setup, first and second peak setup, and then first and second true setup. So over here, we're just looking at what's going on here. Okay, so now we're waiting for this market for the price to bounce back to any of these trend line drawings to make it the third touch. Remember, you use the first and second peaks to draw a trend line, and then we use the third to enter a trade. So at this point, we're just waiting for this price to either come back to this same level, to this same trend line hits, and then a sell trade will be executed. Or better still, when breaks from here, when the market comes, hits on this, and then maybe probably creates a sell signal, and then we sell from there. Or better still, the market bounces back to this stronger trend line, and then maybe for some reason decides to bounce back again, and then a good sell will be valid at that point. So we're just going to flip over to the next page. So as you see how this trend line scale ups works. So this is the exact trend line scale up. So over here it says outer trend lines. This is outer, this is outer, and then this is inner trend line, this is inner trend line. Why are they inner trend lines? Now these trend lines are drawn inside the outer trend lines. Okay, so this is the reason for which they called this trend line inner trend lines. These are the reasons why we have inner and outside trend lines. All right, so we're just going straight to our next topic now. For most beginners, the confusion begins when they look at a chart and see too many lows and highs, and they just cannot figure out which two they are going to use to draw a trend line. So these are most challenges that a lot of traders out there are facing. They just look at the scale ups on the charts, and then they don't know, how would I draw this, how will I scale up this thing, how will I do this, how will I start, where will I enter from. So these are some of the facts that we are here to teach you guys. So all you do for me, please, is this your first time of meeting me? My name is Toby. Please hit on that subscribe button right there if you want to stay connected with what's going on right now. In this tutorial, we're going to be showing you how to identify a trend line that is valid and which one that is not. And then most of the times, so we've come to discover that a lot of people find it very difficult to draw a trend line that is valid. As soon as they draw a trend line, whether it's valid or not, they assume that they have done the right thing, right? But there are trend lines that are not valid in this system, and when drawn, that's where you find out that you place a trade looking at a particular level, and then at the end of time the market breaks the level and keep moving. How would you know a trend line that is valid and which one is not? Please, if you want to know that, please stay connected by clicking on that subscribe button right there, and then the notification button, so as to turn on to get notified whenever we upload stuffs online, whenever we upload new videos regarding this training. All right, so this is season 2 of this section of the training. We're also going to be looking at some technicalities here too. Now, for most traders, as I told you, the confusion is always there, and then when they look at now, just look at what's going on right now. Look at what's going on right now. We have too many highs, too many lows, and then they just can't figure out which of the two they're actually supposed to use in scaling up their trend line and levels. So these are the challenges young traders are having out there. So in this case, the solution to this problem comes down to prioritizing which lows or highs to use, and the general rule is this. Now for lows, the one with more higher candlesticks on its left and right will be more significant. The one with more candlesticks on its left and right, the one with candlesticks on its left and right will be more significant. The one with more candlesticks on its left and right will be more significant. The one with more candlesticks on its left and right will be more significant. So this is what it means. We have one here, we have one here, we have one here. Now looking at this, you find it very difficult to identify something nice to be used in trading here, to use in making good trading decisions, and this is why this is very significant. So here, that's why you see this trend line scaled here, and then it works the same for high, except that is completely opposite. Okay, you should be looking for more lower candlesticks or more lower candles if you want to draw your trend lines. You should look on that. So the chart here makes this concept a lot clearer. As you could see over here, it said there are three significant lows on the chart: number 1, 2, and 3. And notice that on each of these lows there are more high candles on both and left and the right side of the low, or which you see over here. There are more lows on each candles here, as you could see. Now the right side here, we have more trading opportunities that actually appears on this right side. So this is the reason why we choose to take our trades, maybe probably when the market moves from the left, and after drawing the trend lines, then looking at our right again, we find out that good trade setups has scaled up, and that's why we execute our trades from. So in this case, in other words, you look for highs and lows that are easy to spot. Now let me explain further. When you select the two highs for drawing downward trend lines, or the two lows for drawing upward trend lines, they must be visible or obvious to everyone else. Very visible, obvious. There should be no ambiguity. So everyone else must be able um, to see or spot them clearly. And if the lows or highs can be clearly seen and identified, that means that they are significant, because that is where the market has been observed to reverse significantly from. Okay, so at this level, we just take our experience from what we're seeing on the chart. Now on the chart here, how many visible or obvious and therefore significant lows can you find? How many significant lows can you find? Actually, I see 1, 2, 3 significant lows. Okay, I see 3 significant lows. With this also, how many significant lows can you see over here? And then looking at the right up here at this article here, it said, can you show me which lows are obvious and significant? So if they tell you which of these lows are more obvious and significant, what are you going to do? Are you just going to point these, and just trying to make scaling of all these things you see? No, actually there are significant lows here that are very valid. Okay, so we're going to look at our next charts in order to know which ones are significant and obvious. As you can see over here, these are the obvious picks, and then we look at the action here. Now this is where we took our trade from. This is where the trades are entered from. Remember what, as I told you from season 1 of this training, I told you that 1 and 2 of these picks are used for drawing of trend line, and then the 3rd, 4th, 5th thereabouts are used for entering trade. So this is just most of the facts that we ought to understand. Now here is another one. Notice on the chart um, how the lows and are obvious, okay, and therefore easy to spot. You could see over here, very easy to spot because they are just in a single file. Very easy to spot, significant, and the result is you get a nice upward trend line that bounced on the trend line drawn, and then the price keep moving up, and then continue to go up. So this case, you the trader, you have more advantage to the market. You have more advantage of making some money. Now the two lows where the trend line is drawn must be obvious and easy to identify. So you could see over here. So this just to like show you different examples of trade scale-ups or trade setups that happens, trade setups and patterns that actually happen in our trades. So if we are to actually identify or define what happened here, this is going to be like um, um, bottoms. I think these should be identified as bottoms. Okay, so but then we've done the scale up, the trend line scale up, so as to make it easy for us to get the exact entry points we needed to make a good trading decisions. So the two peaks where the trend line is drawn must be obvious and easy to identify. So it's same thing that happened at this spot, same thing over here. This is just like opposite of it. But then you could say that you just all you need to do is just do what the market asks you to do. The market says, okay, if I come test second and third, you just enter a trade, and you make good profit out of this, out of just doing this obedient thing with the system. So the forex market, as you could see over here, is something that we all ought to understand how it works first before we venture into it. So, but I also noticed that many great trade setups occurs on trend line drawn from significant lows or highs, or from combinations of both significant and insignificant lows or highs. What can you say about that? Okay, so looking at these significant lows and highs, what can you say about these ones? What can you say about what you're seeing with your eyes? Now, if you are a beginner, to avoid the confusion, stick to only drawing the trend line and based on significant highs, peaks and lows, truths. As you gain more experience and confidence, you can start trading off trend line drawn on significant lows or highs, or combination of insignificant or significant lows and highs or highs. So you might just want to stick on drawing the trend lines alone to use it in making profit. So in this system, all we require is just please trying to develop that attitude of drawing trend line. I bet you're going to do very well in this. You're going to start making some good amount of money on daily basis. Just like this morning, I've made some good few $100 this morning, and then I'm happy with what has happened. So I just want you guys to please, if this is your first time of meeting me, my name is Toby again. Please try and hit on the subscribe button so as to get notified whenever we upload new videos that concerns this trend line trading strategy and the trend line breakout strategies, significant lows and highs, how to identify them, or how to spot trend line correctly, how to draw a valid trend line, how to know when trend line is still valid and when it's not anymore. I tell you, there are trend lines that actually expires. That's what I'm trying to let you know. There are most trend lines that when drawn after some time, that trend line becomes expires. How does this happen? Now, a trend line expires when the trend line is not properly drawn at the right spot. All right, guys. So please let's continue. The next we're going to be discussing valid and invalid trend line. Okay, so we're just going to be looking at what we have next: valid and invalid trend line. Please subscribe to our channel, our YouTube channel. If you need more inquiries, you may just want to contact us through using our YouTube channel, which is if you click on YouTube, write in Forex Trade Academy, you get to you have access to speaking with us. Okay, so these are trend line runs from significant highs. Let's, I think we should may just want to go back a little bit. So these are trend line runs from significant peaks or truths. Okay, and then it does take a bit of practice and skills to be able to draw inner trend lines when it comes to picking which 2 points to use. Now, the more you practice, the more you are likely to identify um, which trend lines are to be used and which one are not. Okay, so we're just going straight now. A trend line is valid as long as it is not intersected. Okay, the trend line is valid as long as it's not intersected significantly, and the price continues to obey as the price continues to obey it. And then a trend line becomes invalid when it is intersected significantly, and this could mean that the trend has now probably changed. So whenever a trend change, there's whenever a trend line is being intersected, I think significantly it means that either there is a change of trend. Okay, yeah, there is a change of trend. That's why we see that happen in most of our trades. How can you tell if a trend line is intersected significantly? Now, which could mean a trend line breakout or not. Now, sometimes we actually have what is called trend line breakout, but we're still going to teach it on the course of this training. Now, there is no exact formula to determining that, but here are three things that I look for. Now, one of them is the candlesticks that intersect the trend line. Has it closed above or below? So you have to consider all this. And then the two is the length of the body of the candlestick, if it is long or short, that's closed above the downward trend line and below the upward trend lines. So what is actually trying to explain now the three? Okay, let's just finish with the third one, then we explain. So the close, which is third one, I say the close of the 1 hour or 4 hours candlestick. Now I will explain now in details. Now the candlestick that intersects the trend line, has it closed above or below? It is a candlestick closes, if a candlestick closes above a downward trend line by a significant distance, then that may be a signal that the downward trend line is now violated. Yeah, so the opposite is also true for an upward trend line. If the candlestick loses or closes below it significantly, that may be a signal that the upward trend line is now violated and the price would now be heading up. Okay, so if a candlestick just intersects but fails to close above stroke below a downward stroke upward trend line, then expect trend line to be obeyed. So this is just it. So in other words, if a candlestick closes within this range inside here, I tell you, then expect the candlestick to obey and then fall back into the trend direction. Okay, so this is just how it works. And then the length of candlestick, I say the longer the candlestick length, or the longer the length of the body of a candlestick, that closes above stroke below a downward stroke upward trend line, the greater the possibility that the trend line has now been violated. Now notice, if you see that a shorter length of the body of candlestick that intersects the trend line that closes above below a trend line, this likely to be an indicator that market has to indicate, or an indication that market has lost the momentum, and even though it has intersected the trend line and may close above below it, Now there is a greater possibility that the price will continue to obey the existing trend lines. Now you would need additional confirmation, and the best way is to use a reversal candlestick more on that later. So this is the very reason why we like to, before ever we decide what's going to happen. Now, whenever there's an intersection in this form, what we do is that we have to stay for some few moments. If that, let's take for instance this is a 1 hour candlestick, and then there's an intersection. All we do is just to please be patient to see whether the market will fall back into the trend line, into the trend line direction. Okay, when that happens, what are we expecting to be sure? We are expecting a reversal signal to appear here, like same way a reversal signal appeared. This is sell reversal sell signal, and we expect a sell signal to appear here before we make our trading decision, in order not to make mistakes. Okay, so the close of 1 hour of and 4 hour time frame candlesticks are very important in determining if the trend line is likely to be broken or not. Okay, if you see a 1 hour candlestick close below an upward trend line, then there is a greater chance that that trend line is now intersected and price will continue to move down, if that be the case. Now the opposite is also true for downward trend line. Now generally the 1 hour trend line closes above or below a trend line, that closes above or below a trend line has more significance than any other time frame closes. Okay, so in this that is why on many occasions you see a trend line intersected significantly in a much smaller time frames like the 5 minutes, 15 minutes, or 30 minutes, and you may think that the trend line is intersected, but then the 1 hour candlestick eventually closes. So we're just going to look at some other structures that we have over here that we need to treat over here, and then we now looking at what's going on over here. Let's now, what does this tell you? Looking at this chart, what does it explain? This chart, what does it explain? Now, what can you see about the length? What can you say about the length of the body of the candlestick, numbered 1, 2, and 3? Do you notice something, and what happened after that? 1, 2, and 3. What do you notice? Now, over here, now to this direction, now we notice that the markets climbed from here and then moved the first candlestick, and then moved another, and then the third one, and probably comes to a level, a trend line level, and then hits the trend line, and then continues to come down. So we're just going to flip back a little bit to see what the result of that happening brought. Okay, so this the exact result, this is the result of that particular trade. So 1, 2, 3 over here, and then afterwards the market dropped down heavily. So these are some of the signals that actually happen. Now the first chart above, this first chart shows two very bullish candlesticks, 1 and 2, with very long bodies indicating a very strong upward momentum. Then 3 candlesticks is formed by contracts. Okay, it has a very shorter body than the first 2, so we can we know the market is losing its steam. And the second chart also is what happened as a result of the 3 candlesticks that got respected over here, and then everything just starts falling in place, and then the market starts going in profit. Notice that this candlestick closed above the downward trend line, but notice that it lacked momentum. Shorter body, and the next bearish candlestick confirmed this the trend line is obeyed once more. So in this case, you just go into, just look at what happened over here and then see how the market dived down. The market moved over here again, 1 2 3, and then fell down back again, and guys made a lot of profit out of that action. So in our next tutorial, we're going to be talking about the common mistakes that are likely to be found in drawing trend lines. Okay, so guys, my name is Toby again. Please stay connected. I love you.